Hey guys, Brian Stevens over here at Mortgage Shots. Hope you guys are having a great week, and I hope you're looking forward to the holiday seasons. Now, I do have one point before I get into a ton of information that's going to help loan officers and real estate agents out with their business, navigating these turbulent waters, as we like to say, and they are turbulent. All right, some cold hard facts that we have to consider about the market that we're in. And yes, it's the holidays and everyone wants to be merry, but I want to be pragmatic about this for a minute. 77% of people can't afford the median price of a home right now. If they wanted to buy one, you're looking at about 23% who can. That number ain't good. 70% of people live paycheck to paycheck right now. Frankly, I thought that number was going to be a little higher. 140 million people are poor to low income. Number's going to get a little bit worse as we're considering a $30 minimum wage here in the state of California. Think about this for a minute. You up the minimum wage, everything that we consume on a micro level, movie tickets, eating out, groceries in general, these type of things, well, the cost of all of those go up because our minimum wage workers, well, that's where they work. What it doesn't do is affect the income of the middle class. It only helps those who are on the lower socioeconomic rungs of our society right now. But by making things more expensive for everybody, because that's what employers have to do, it's going to take that earning ability of the middle class who doesn't get anything, and it's going to take each one of their dollars and it's going to lower the value of that, ultimately hurting everybody in this country, and 100 million people have medical debts. Well, that's a cheery way to start the day now, isn't it? But here's the thing. This is going to make it better for your job because you're going to get to sharpen your teeth in a difficult market. And when things change, and they will, and they are, for the better, then you'll have your systems in place and you'll understand what a hard market looks like, which makes an easy market really fantastic. It's kind of like, could you imagine being a running back in the NFL and all of a sudden you got to run a couple of games at a junior varsity high school football game? You'd rack up like 1,000 yards in one game. Okay, let's go get into the meat and bones of what we're talking about here. The birth and death rate spells trouble for the United States housing market. If we have a negative growth rate in this country, we're going to see a massive and precipitous fall in housing prices. They're claiming here the Census Bureau is claiming by 2032 that we're going to cross over into a negative birth rate in the United States. Now, without massive influx of immigrants into our country, that means we're going to have a surplus of housing, which is going to drive the price down. Now, you're thinking 2032, that's not too far away. We're going to start to see this happening right now, not just because we're going to have a negative growth rate in this country, where your average new family formation is having less than 2.7 kids for said formation, but also because the vast majority of folks who own real estate in this country are going to be senior citizens. It's somewhere upwards of the tune of 75% of all equity in this country is controlled by senior citizens. That baby boomer generation is getting older. It's my parents' generation. And as they fall off, all that equity is going to come back, and a lot of that property is going to be sold off. That equity is going to be realized, and then, of course, my generation is going to use that money for more significant down payments to buy houses, but we are not as big as the boomers. So this spells a great opportunity for both equity and for inventory in the housing market in the coming years, something that is starting to come on track as we speak here. So even without new home builders doing exactly what they need to do, which is build more houses to bring affordability back, we've got a number of different variables at play right now that are going to guarantee that we will have more inventory. Again, I'm not trying to be morose about this. I'm trying to be pragmatic and honest about the reality of our situation. The crossover point will be continuation of a long-term trend over the last 4 decades, and ultimately is going to have the following impact. A, structurally lower home buying demand, a decline in birth rates and family formations, lower the need and urgency for young people to buy houses, and B, more inventory as incrementally more deaths and the aging out of the baby boomer generation increases the listings. And this is according to Fannie Mae, and they're claiming that 9 million homes are going to be on the market by 2035. That's a massive, massive number, and that will, in fact, drive prices down and bring affordability back. Also, it's going to have a massive effect on inflation. What we're going through right now, guys, I know it's going to be a tough holiday season. This isn't going to last. This is likely going to have a disinflationary or deflationary impact on home prices over the long term. Like it or not, affordability is going to come back in spite of how much our elected officials are trying to screw that whole thing up. Who owns the property in this country? 42 years and older. The median age for home buyers was 42. This is repeat home buyers in 1991. That number has now jumped to 61, and I gotta tell you, this is wildly, wildly unhealthy. And it's because people simply can't afford to buy houses right now. I'm telling you what you already know. House payments as a percentage of median income from 1967 to 2024. Does anything jump out at you at this graph? Well, we've got three massive peaks over there, followed by precipitous drop-offs. We have 1981. We have the Great Housing Meltdown. That was in 2006, 7, and 8. Well, you can see that right there. And, of course, we're looking at the third one. What do you expect to take place with housing prices if we are simply to look at this graph and gauge history going back to 1967 with house prices in the coming years? And we're already finding the tremblings, the pre-shocks before the earthquake of what is about to take place. And that is, we're going to see a correction in housing prices. Listen, it is not healthy when 75% of people right now cannot afford the median house if they chose to buy it. 75%, that's veritably everybody in the country. Now imagine how many people would buy a house if they could buy a house. Affordability coming back is not only going to bring those who aspire to own a house right now back into the home buying pool, it will bring those who aren't even considering it because they see it as something that's not an option for them. 1 year change in home prices in America's 50 largest metro areas between 2024 and June of 2025. Well, we can see over on the left-hand side, we have a whole bunch of places that are not called your sand states. Your sand states would be the areas that people like to go, where second homes are available, where people like to Airbnb it. Vacation destinations, California, Florida, Arizona for all you snowbirds. That's on the right-hand side. You see, when we have our sand states, these are the ones that ebb and flow with the biggest peaks and the largest and deepest troughs. On the left-hand side, you're still seeing property values go up. U.S. metro areas that gain population. Gaining population is going to put more demand on housing, which is going to drive prices up. And if you look at all the green where we've seen the biggest population growths on this graph, they are going to mirror the blue on this graph. Where we see the lowest population growths on this graph, we're going to see it mirror the red on this graph. So if you're living in generally a highly regulated, high tax area where people are trying to get away from, we're going to see property values dropping, even in California. And you'll notice on this graph over here, the only places in California that you see that have any type of population growth is Riverside, because it's kind of a destination location and it's a pocket in LA. And the other one is Fresno. Fresno is very similar to a Midwestern type of city. U.S. unemployment rates since the Great Depression. Here's the thing, what they're projecting is very complicated for us. During the Great Depression, over on your far left-hand side, we saw 25.6% unemployment. It's the highest peak that you're seeing here. But what's being projected right now, and this is absolutely scary, is on the far right-hand side of this graph, where the turquoise turns to kind of an oxblood red. We're anticipating unemployment to jump up to 15.5%, but even further, and if some of the prognosticators out there who've got the pulse on this stuff more than I do, they're expecting this to get somewhere up to the tune of 24.25%, higher than what we saw during the Great Recession, and very close to what we saw during the Great Depression. Mortgage credit report costs, they could jump by 50% in 2026. My God. This is so ridiculous. Now, I don't want to sound like an out-of-date old curmudgeon over here, but back in the day when I started writing loans in the late 1990s and early 2000s, and boy, did that time go by fast, our credit reports, were $12 for a single bureau. They're $25 for an RMCR. That's a residential mortgage credit report. A tri-bureau merged just for our consumption. They cost like $25. Right now, we're like 80-something bucks for our credit reports, and they're going to go up by another 50%. This is all happening at a time when we thought that credit reports, the cost of them were going to go down. It's what Ronald Reagan said, we start to get government involvement to regulate in the name of customer or consumer protection. When that happens, the cost of everything goes through the roof. Now, if that's consumer protection, do me a favor, stop. Just stop doing it. Mortgage lenders will see credit report costs rise by up to 50% in 2026 amid FICO's new model. The trigger leads ban taking effect in March, and expectations for the exception of Vantage Score 4.0. Credit report prices for mortgage lenders are going to increase by 50% despite the regulatory efforts to boost competition and recent pricing shifts by some players, resellers told Housing Wire. It will mark the fourth consecutive year of higher costs. See, inflation. It hits all components of our lives, including our credit reports and buying a house. And it doesn't need to be this way, yet here we are. The increase is tied to credit reports that originate with FICO information and flow through the three major credit bureaus, Experian, Equifax, and TransUnion. This is because resellers are not yet offering a new direct program launched by FICO in October, and because VantageScore 4.0 that was accepted by Fannie and Freddie is not yet operational. If it is operational, is it going to bring the cost down? I hope so. Residential mortgage-backed security issuance of non-QM loans hits a record $20.9 billion in the third quarter. The surge in issuance came even as credit performance showed signs of strain and the broader economic climate cooled down. Guys, I can't even explain this enough to you right now. Non-QM is going to continue for the foreseeable future to be a bigger player in the mortgage market. It simply is. Why? Your agency deals, your Fannie, Freddie, Ginnie loans, being your FHA, VA, and USDA loans, they are exclusionary loans by nature, particularly your agency Fannie, Freddie deals. They're exclusionary. They don't want to do your loans right now. Non-QM deals are inclusionary loans. Those who are backing these loans are trying to find more and creative way and logical ways to fund deals. U.S. non-qualified residential mortgage-backed security issuance reached a record $20.9 billion. Expect that number to go up in the third quarter of 2025, nearly doubling, massive, nearly doubling the level of the same period in 2024, doubling. As people are pulling back from agencies, doubling. Despite economic cooling and credit strains, the sector showed resilience with stable deal performance and increased credit enhancement. The surge in issuance came even as credit performance showed signs of strain and the broader economic and housing environment cooled. The report found that monthly, quarterly, and annually non-qualified residential mortgage-backed security volume reached a record high, the total of $20.9 billion in the third quarter of 2025. In regard to credit performance for those pools, delinquencies of 30 days or more ended that quarter at 5.65%. Little change from the second quarter, but 33 basis points higher than a year earlier. Listen, if you look at what's happening with FHA right now, they're not performing as well as your non-QM. If you look at your agency deals with Fannie and Freddie, their defaults and non-performing loans are going up too. In fact, they're going up faster than non-QM loans. I'm telling you right now, this is a future of what you need to do. If you want to find people who can afford houses at this high price, you know, that 25% who can still actually buy a house right now, the vast majority of them are gig workers, self-employed workers, and people who own their own businesses. All of those people are going to be non-QM loans. If you want to find people with more money so you could do more loans, you need to write more non-QM loans. It is as simple as that. Fannie Mae and Freddie Mac shares mimic meme stock mania with wild swings. Here's the point that I want to make on this. What are the wild swings that we're talking about? Without going into massive detail, you may or may not remember when they went to conservatorship. Fannie Mae and Freddie Mac, for their illustrious near 100 years of operation, have been the most philanthropic company in the world, and also, next to NVIDIA, who just recently outpaced them, the most profitable company in the entire world, working on nothing but the United States housing market. During the last meltdown, they had to go into conservatorship because they were insolvent. Conservatorship, by nature, is intended to right the ship of a failing company and then hand it back to its shareholders. That's what conservatorship did. Fannie and Freddie are in the longest conservatorship in the history of the United States. They beat out Britney Spears. Britney Spears is the longest conservatorship in the history of the country, where family took away her autonomy and took control of all of her finances. Agree or disagree with that? They held on to it too long? Well, that's what the federal government is doing with Fannie Mae and Freddie Mac, the government-sponsored enterprises. Prior to that, there were public shares that were sold off, and stocks of Fannie Mae and Freddie Mac have been sitting in people's retirements or 401ks. They've been sitting in there for sometimes decades and decades. Well, when they became insolvent, the federal government came in via the Treasury, and they created a new stock. That new stock is called a preferred stock. And that preferred stock made all that common stock that had been around for nearly 100 years, where it was a government implicit guarantee backed by private income, me and you. Well, all that private money that was invested into Fannie and Freddie became basically worthless. There was no dividends being paid, and there was no money going out to the common stock because the preferred stock that the government, through the Treasury, created essentially took complete control over Fannie Mae and Freddie Mac, created the FHFA, to put them in conservatorship and control them, very similar to Britney Spears. And then what they did is they changed the terms of the conservatorship and decided that they were going to keep all of Fannie and Freddie's profits. Remember those record profits I just told you about? They're going to sweep them on a quarterly basis, guaranteeing that they would be insolvent in perpetuity. Did you know that the multi-billion-dollar bailout that Fannie and Freddie participated with back in 2009 and 10, do you realize that that wasn't a bailout? It was a hostile takeover. And Fannie and Freddie to this day, though they've paid out said bailout of billions of dollars multiple times over, have literally not paid down 1 cent of that debt. Well, now they're looking at actually releasing them and dissolving that preferred stock and giving the stock back to the shareholders of that common stock after over a decade. They're really kind of pushing 2 decades right now. And as a result of that, Fannie Mae and Freddie Mac stock have surged over 500%. Just on anticipation of having that common stock go back and being worth something. Fannie Mae and Freddie Mae sees volume near $2.5 trillion by 2027. Yes, you heard me right, friends. That's trillion with a T, not billions with a B. If you're looking at this right now, that's a purchase market in the dark blue down below, and it is the refinance market, meaning for the foreseeable future, we're going to see refinances represent about a quarter to a third of all business. And that number is going to increase in years to come of those that have the 2 and 3% interest rates, who've got the golden handcuffs on their house, who are not going to refinance and not move. We will invariably cycle through those, which is precisely the reason we can't go back into the 2s and 3s as some people are asking for. It is the market of the 2s and the 3s that have created the problems that we're facing today. Where are you going to find your business loan officers? You're going to find your business in the purchase market. How are you going to get more purchase market business? Take all that animosity you have towards real estate agents and just throw it away. It does you no good. In recent day, billionaire investor Bill Akerman advised the Trump administration against expediting initial public offerings for Fannie Mae and Freddie Mac, presenting a 3-step reform plan that includes treasury stock, warrants, and potential relistings on the New York Stock Exchange. Akerman's call for deliberate preparation highlights the policy and market complexities involved in reforming these government-sponsored enterprise giants. It's kind of ridiculous, and it's a little disconcerting that any administration would listen to anything Bill Akerman has to say, because I guarantee you this, if there's one thing we know about Bill Akerman, whatever he says is not necessarily, could be, but not necessarily in the best interest of that industry. It's definitely going to be in the best interest of Bill Akerman. I think a recap and release is a great idea for Fannie Mae and Freddie Mac. I just don't know if right now is the time to do it, because most are speculating that if we do go back to the quasi-private government relationship, that we're going to see an uptick in rates. I don't think we should see 2% interest rates, but I also don't think we need to be seeing 9% interest rates anytime soon. Now this one right here. HUD's English-only directive could hurt the Federal Housing Administration's mission and financial health. All right, I'm just going to call this one for what it is. Stupid beyond belief. If we are to have a directive that HUD is only going to communicate with people in English, of course it's going to hurt housing. Of course it's going to hurt HUD. Of course it's going to hurt the FHA. And yes, it will hurt their mission statement. The mission statement of HUD via the FHA is to serve underserved communities. Many of those communities are English second speaking communities. And if we get away from some of those second languages, what's the point? What's the point? We've got serious problems right now in the housing industry and with all of our government loans, which represent a solid 90% of all loans that are being written right now. Having an English only approach or directive right now flies in the face of logic. Well, it turns out Zillow's up to their same old tricks. And for more on that, we're going to hand it over to Madison Jones. Madison, what's going on?
Zillow just teamed up with ChatGPT, and I'm just over here wondering if anyone's even read the real estate laws. So here's a new stellar idea that Zillow had. They've just become the first real estate app inside ChatGPT. Yep, now you can ask ChatGPT for homes for sale in Los Angeles under 1.5 million, and Zillow pops right up in the chat. Sounds futuristic, sure. But from where I sit, and I've been in the real estate game since 2006, it raises some eyebrow-raising questions. First, what about the rules of the games we realtors live by? For example, the data from the MLS says each MLS must check if a tech display complies with the IDX rules. Is the data transmitting to an unauthorized party? Are disclosures being met? With Zillow's ChatGPT integration, some industry experts are saying, this looks like MLS data showing up on a third-party platform without full control. Second, this just isn't about tech, it's about visibility and power. When Zillow controls how, where, and whether listings show up in new channels, it starts to act less like a passive platform and more like a gatekeeper. That's raising antitrust eyebrows, and now they're making their own industry rules. And third, how does that affect you, the realtor on the ground, if Zillow becomes the go-to entry point via ChatGPT nonetheless, and funnels leads and clients' attentions its way? You might not be the only one calling the shots anymore. Your listing might show up, but how prominently, under whose terms, and that's kind of a bad look for agent autonomy. In short, yes, innovation is cool, but when one platform can engineer a must-go-through-us channel, maybe we're trading innovation for consolidation of power. That kind of looks like a monopoly game to me. And for you as a real estate pro or consumer, that could mean fewer options, less transparency, and more dependency on whoever controls the tech. If you're working with me or any other local reputable realtor, you're not dealing with a dark algorithm gatekeeper. You're dealing with someone who actually works for you, knows the market, picks up the phone, and won't be sidelined by some chat app redirect. Want that kind of real service? Give your business to people in your community, not a corporate Godzilla. Let's talk. Drop a comment if you're curious or as skeptical as I am. Or if you have any other perspective, let us know.
I hope this helps you, and you have a great day, and get ready for Thanksgiving. Again, over here, I'm having tacos. Let me know what you're having down below, and of course, any questions, give me a ring.